Good afternoon and welcome to the Hargreaves Services PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO Gordon Banham. Good afternoon to you.
Yeah, good afternoon and welcome everybody, and thank you for taking the time to hear how the Hargreaves journey is progressing. I jokingly said this morning, if there was a gold medal for going from black to green, Hargreaves must win it. Those of you who knew us a long time ago when we listed, we're a coal company, we're now very green. And it's amazing where the company's come to. We set out a load of strategic commitments to shareholders previously, and I'm pleased to say we are delivering against them. For those of you who don't know the company, we'll just talk about what the business is. So this first slide, it's a sum of the parts play. So what you get with Hargreaves is three pillars, as we call it. So talking about services, had a very good period. We're doing very well. There's volume in the services sector. We'll talk about it in a bit more detail. We've got a margin maintained at 7%, 11% increase in revenue. And subsequent years, you'll see the brokers have increased the profits for subsequent years, which shows that we're building some real momentum there. Land, again, those who know us really well will know that there is effectively three parts to the land business. You've got the historic mining sites, which are held at historic cost, so not market-to-market pricing, so they are very low cost. So there is a lot of pent-up value in those old sites. There is the renewables, and David will talk about that in some detail and give you a breakdown. We hope that in 2025, we'll be able to tell you that we've actually sold the first tranche, and we hope that is the start of a rolling program of turning these into money. Remember, we don't spend any money. We're actually a landlord. So as soon as someone builds these wind farms, we get rent and then we sell that income stream on. And I hope that we will do something before the end of the financial year, but brokers forecast are hopefully that something will happen in 2025. So watch this space. I think there's going to be a lot of news flow from Hargreaves over the next 12 months. So there's a lot to keep you informed on, and David will cover that. And then finally, there's the move in David's business to the low capital model. And what we say is, look, he's got a pipeline of nearly $1 billion of GDV, and we would hope that that would give him something like 3 million a year recurring income stream after overhead. So a nice land business. I always say that, David's job, although in this period we talk about the fact that one of our transactions has moved just beyond year end. So being open in November, we budgeted it to happen. Last year we budgeted to happen in November. It's probably now going to happen June and July, so it's moved out. David's main risk, I think, is delays. The value is there. Remember, we hold this at historic cost. So I've tightened up with the team and said, look, we need to deliver a sum of the parts in the next 5 years for shareholders. And so we're putting a timeline on it. And what we also say is, we've increased the dividend. We've talked about a progressive dividend. We're now talking 37p. So based on when we started the roadshow, a share price of £6, we're paying people 6% on their money to hang around. When you do the full sum of the parts, some people are talking about some of the parts worth 9, some are saying it's worth 12. You make your own decision from this presentation. If it was 9, based on 6, £3 increase, 50%. So in theory, you'd hope over 5 years, we as a team can deliver you 16% growth for those 5 years. And it'll be interesting to chat through why I think that's potentially achievable. And maybe you'll believe there's a higher upside number, but we'll get into some detail. And then I'll talk about Germany. That's the third pillar of the business. It's paid its dividend over to us. It's performing much better now. And again, we'll give you some flavor. So what I'd like to encourage you to do is, as we go through, do your own valuation and work out the sum of the parts, which will help you understand what this business is worth. I'll now hand over to Stephen, who's our CFO, who will talk you through the numbers for the half year.
Thanks, Gordon. So good afternoon, everybody. Just a quick canter through the P&L for the first half of the year. Really pleasing, revenue up within services quite substantially, 11% growth, and that's fed through to PBT within services up £1 million, so 13% growth there, maintaining a really healthy margin of above 7%. That growth has been driven by additional opportunities and increased activity, predominantly in major earth-moving infrastructure projects, which are really starting to come to the fore now, and are the main driving force behind a recent upgrade from this morning in the broker forecast numbers. In terms of Hargreaves Land, revenue's never really the best metric, but on terms of the result for the half year, a loss before tax of 1.4 million is down on the previous year, but this is all timing related. The post-period end in January, we sold a £9 million plot to Avant Homes. Had that happened 5 or 6 weeks earlier, then we wouldn't be talking about a loss before tax. So this is the sort of the impacts of timing on land more than anything else. One of the really good stories in the first half of the year, though, has been the turnaround within HRMS. So if you were on the call 6 months ago or 6 months prior to that, we were talking about the challenges that are within the HRMS business, particularly DK. We are coming through the other side of that now, and the business is broken even in the first half of the year. We've got a slide coming up on why that's moved so far in our favour, and some of the interesting work we're doing to continue to improve that. Corporate costs have remained flat, and tax is at 25%, as you would expect. EPS grown as a result of the profit. Really want to highlight the increase in the dividend per share. This time last year, we increased the dividend substantially, and we promised to continue with a progressive dividend policy, and that's what we are doing. EBITDA also grown by 21%, reflective of the contribution from services continuing. In terms of what's tied up on the balance sheet, where is all the cash invested? If I take it column by column, the services business continues to have a low capital model. Whilst capital employed has doubled from the previous, or indeed from 6 months earlier, that's really coming from a real low point in May 24. That's never really where it would always be. I'd expect it between sort of 9 and 12 or 13 million. Within services, delivering those profits is a great return on capital employed, and we're very happy with that. In terms of land, we've got an increase in the total capital employed in land from 79 to just under 85 million. This reflects the continued investment into Blindwells. However, as I mentioned on the previous slide, a sale at Blindwells occurred in January, post numbers, which would start to bring that number back down the way. I'm confident now we are at peak with Blindwells in the inventory in general in land, and we'll start to see that unwind as we move towards that low capital model we've previously outlined. Within HRMS, previous capital employed was 70 million, now down at 62.7. That's reflective of, well, in the first half, no profit really with a break-even position, but we have received our dividend in the first half of the year. So that's continuing to bring that capital employed number down and has helped to fund the dividend that we paid in October. In terms of unallocated assets here, 31 million in total, of which half is cash tied up, is our cash, sorry. One interesting point I'd just like to draw out, the 4.9 million in other working capital, and this will probably be the only time I ever talk about other working capital in an unallocated column, but 4 million of that 4.9 relates to the loan that we gave to the pension scheme just under a year ago when we bought the scheme in. That was to help fund that buy-in. I'm pleased to be able to say in January we received that 4 million back in full, and we no longer have any loan out to the pension scheme. So we're just waiting for the buyout to complete once they've finished all their data checks, which probably should complete in early 2026. And the other item on here is the deferred tax assets, which is at 9.8 million, starting to come down as we're starting to utilize these tax losses that the business has built up. We've probably got 4 to 5 years of being able to use these losses still to go. Next slide is really just, I guess, a fact sheet for doing your own sum of the parts and some of the factors that we might think are useful. So Gordon talked about the sum of the parts, add the three together and come up with your own valuation. They all probably require different methodologies. So the services business, steady revenue growth, great contract book, good order book, good visibility, an earnings multiple of some sort would be the natural fit here. EBITDA in there of 27 million reflects the consensus forecast figures as of 6:59 this morning. They do not reflect any upgrades that the brokers have put into their forecast numbers. You may apply whatever multiple you think is appropriate for the business into that and come up with a number. In terms of land, book values held at historic cost of 80 million. Now, as we move to a capital light model of round about 20 million left in the balance sheet, we'd hope to realise during that period of time approximately 60 million, plus making a profit on the way through. In addition to that, we've got the renewable energy assets, which are on the books at 7 million and have been valued independently at 27 million. So there's additional upside there, 80 plus 20. You could see yourself getting to 100 million on a very conservative basis. That excludes any profit on the upside. So that's where we would look to on land. And then in HRMS, the book value is just under 70 million, as we saw on the previous slide. In terms of valuing this at the moment, we would suggest you'll at least get book. There are some reasons to be more positive within DK in the longer term. That may result in a better result than just book. However, for conservatism, maybe stick at book, and hopefully you'll come up with a number that's not far off the figures that Gordon was talking about in his first slide. Quick romp through the cash flow, just to show what's going on in the first 6 months. So we started the year with 23 million pounds in the bank. Then we made some EBITDA profit of 15 million. However, we then invested into working capital. So 5 million of that is the Blindwells investment, which has now been repatriated because we've made a significant sale. And the remaining cash that was spent on working capital is due to that unwind from May, which was an abnormally low position. Interest and tax and net capex are, I think, fairly self-explanatory. And then we've got the green bar, which is from HRMS, the dividends that they paid us in the first half of the year. We've then had leasing payments against the debt, and dividends paid represents the final dividend payment on the FY24 position, which was made in October last year, to leave us at 16 million. And the final slide for my section is just to break out some of the detail on HRMS, which we've done for a few times now. I think it's useful to understand the dynamics between HRMS and DK. So looking in the green section on the top left, splits the revenue out. You can see revenue in HRMS, the trading business, has reduced, but that's not because of volume. Volume is almost exactly the same. What's happened is the commodity prices have come down, particularly the coke pricing has come down, which has reduced that revenue. And in the purple, you can see it's also slightly reduced the profitability, but the margin percentage has remained the same. So all we're seeing is they're trading the same margin, but just off a lower value. The reverse has impacted on DK, though. So that reduction in coke price rather, has helped the profitability within DK. And that's really one of the main drivers behind why DK made a loss of 10 million in the previous half year, that disconnect between pig iron and coke. And then in the current half year, a loss of 4.6 million. It's over £5 million improvement, largely, not entirely, but largely related to the reduction in the coal price they've been able to achieve. The balance sheet's there for reference. However, I would just point to the bottom left-hand corner, which is the total exposure to HRMS, which is now down at 62.7 compared to 70 last year. And one of the things I'd just like to remind everyone, a couple of years ago, we talked about one of the key strategic goals was to try and remove the exposure to HRMS, repatriate cash out of that business and back to shareholders. And if I had this slide up from a couple of years ago, we were at 95 million exposure to HRMS. So you can see we're really starting to deliver on that promise to shareholders. So if I can pass it back to Gordon to just a quick run through services.
Thank you, Stephen. So David and I now take on the baton. Key point is to help you decide the value of the sum of the parts. So we'll take each in turn. I'll cover services for you. Key point here is I actually say what if I was an investor, what could go wrong in services? And I think if you think about it, there's probably three things. You know, you lose a contract, you get a bad debt, or you have the wrong contractual terms. So we've been through an inflation spike of 11%, and we've been through the NI price hike. None of it has impacted on our profits. So I think our contractual discipline is very strong. You don't see massive growth because we're very contract selective. So actually we might potentially be offered a contract, but if the terms don't fit into our 3 golden rules, as you might call it, then we will not do it, which is credit exposure, type of contract that's there. Of course, we can always lose a contract, and that's a risk for anyone. But I think the outlook's pretty positive, and you'll make your own decision. So remember, progressive growth, nothing wrong with that. Inflation-resistant credit exposure. We have appointed Simon Hicks, so we announce here. This has been, a long journey with Hargreaves from black to green. And I have to say that I think we haven't maximised all the opportunities, and it's a criticism I'd level against myself. We've had so many other things to do. So we're strengthening the team with Simon, and we're hoping that he can deliver even more synergies and more opportunities that we think is potentially there. So hopefully that will deliver growth. As we said, 90% is in the bag in terms of the revenue for this year. Just next page. For those of you who don't know the Hargreaves Group, this is the areas that we work in. So it gives you a flavour. We're really exposed to infrastructure. We've got no retail exposure, and we think it's for primary services that are pretty resilient. Over the page. Now, I talked previously about the big projects that are in here. So we have over 65 contracts that sit within those low credit risk, inflation resistant. But the big one is obviously HS2. Now that's coming to an end in 2 years. So it'll go full bore for 2, then probably a 3rd year it's slow. Sizewell is ramping up, which is fantastic. And then you've got Lower Thames Crossing. Now, Lower Thames Crossing is going to be a toll road. So we're pretty confident it will go ahead. And if it does, we hope to be working as the partner to Balfour Beatty on that. We have a strategic alliance with them. So hopefully, if it gets the go-ahead in May, June time, then that will be something we switch on to. And as HS2 goes down, we're hoping Lower Thames will ramp up. Tungsten West is another one. Remember, we were fortunate that we bought the business we bought the site out of administration, and we sold it to Tungsten West, and therefore we had a very good contract. That contract is open book, cost plus 7.5%. But the most important thing to you as shareholders is there's no credit risk. So we have to be paid in advance before we mobilise, and that you have to pay us up front for taking the kit down there, but also for the cost of taking it back before we turn a wheel. You have to cover redundancy, and you have to pay in advance for whatever work we're doing ahead. And you have to keep replenishing that. So the plan is that you have no credit exposure if Tungsten West goes ahead. Now, I don't know if it will or not. They're out on a fundraising exercise this year. It is a strategic mineral, so based on the geopolitics that's going on, I'm probably more likely it will go ahead this year than not. But look, if it doesn't, we have control over the minerals lease, and we effectively get the site back and we can restore it, or we get the site back and we maybe find someone else who wants to buy it and take it on. So I think we're in a very strong position there. So here is the 4 irons in the fire there, but please don't forget underneath that the team are still doing well, securing maybe smaller contracts, but all sitting within the criteria we exist. So here we are, FCC contract, working with Infinium, and working with Your Waste. So that steady growth, I don't expect it to be stellar growth because we are very contract selective, but we are growing, it's going in the right direction. So on that note, I'd like to hand over to David Anderson, who you may be aware, this will be his last roadshow. So I'd like to publicly thank him for all his efforts and commitment. Unfortunately for David, he's not leaving us totally. So he, being a Doncastarian, or whatever you call it, has agreed to look after the Unity project for us on a consultancy basis. But I think hopefully as shareholders, you'll agree with me that he's done a great job in getting hold of the property business and turning it into something substantial. I think everyone will get all the credit now after he's gone, which is a bit unfortunate, but David's decided that he'd like to take it a bit easier, and I think he deserves it after his hard work. So having made him blush, I will hand over to him.
Thanks for that, Gordon. So welcome everybody, and just for people who are new to the business, so the land business really falls in 3 parts. One is where we are effectively operating a master developer. Historically, that is sites we owned, where we gain the planning, we put in structure in, and then we sell plots to house builders and commercial operators. And on that score, in terms of key transactions, Blindwells is our most advanced residential scheme. And in the year, we've completed 2 sales. As mentioned earlier, that the Avant sale fell just outside the half year. And then we've got a further sale to Bellway, and that will be their second site purchase on Blindwells, which we were originally expecting to be completed this side of the year end. But due to some planning delays, we expect it to fall just into next half year. It's just for the avoidance of doubt, it's not an if it will complete, it's a when it will complete. And then at Unity, which is a more recent mixed-use residential and commercial scheme, we've got a couple of plot sales which are progressing with McDonald's and Starbucks. We've now secured the planning for those, and we're on with actually preparing the sites, and they should complete around about the middle of the year. The second tranche of activity we operate in is renewables. Now, this is where we are landowner. We assist renewables developers, those are developers of wind farms and battery storage in the main and some solar, to secure the relevant consents on our land, and then develop out those types of operations. And we lease the land to them on long-term leases, typically between 35 and 42 years, with annual RPI-linked reviews. We're not exposed to development costs or development activity. That's we purely pay a landowner, and we're steadily building up a significant investment pipeline of those sorts of assets. And as stated on the presentation, one of the notable updates was the fact that Copenhagen Investment Partners completed the financial close, i.e. the funding of a large 500 megawatt battery storage scheme on a site we own in southwest Scotland. So we're expecting that to commence on site construction next month. And then finally, the third leg of our activities is planning promotion work. And this is where we secure land, normally greenfield land, under promotion agreements and options and conditional contracts. We promote it through the planning process. This is a medium-term exercise, promoting through the local plans, secure allocations and subsequently detailed planning for both residential commercial uses, and then sell the plots out to end users, most often residential developers and others. And we take a margin out of the added value we achieve. So relatively low cost, good return on capital employed, but it is a medium-term business. But it's feeding the future pipeline for land itself. Over the page in a bit more detail on renewables. So those be aware, the end of last year, we had the renewables assets which had reached sufficiently advanced stage value by Jones Lang LaSalle. These were 11 schemes where they're either operational, under construction, or in the pre-construction stage, but where they have all the consents and permitting, which is essentially planning consent and grid connections. Jones Lang valued those at between 27 and 29 million pounds. The book cost of those is 7.4 million. And out of those 11 schemes, we've taken 7 of those to market. We're currently in the throes of a sales process. Those assets have a book cost of 4.1 million, and the Jones Lang valuation of those assets was 12.6 million. We expect sales to complete during the calendar year 2025. We're not able to forecast whether it will be before the year end or after the year end, but we'd like to target before the year end if possible, but we won't be held to ransom by a would-be buyer. And then in addition to that, we've got a further pipeline of these renewable assets. We've got a further 3 which are contracted and they're in pre-planning stage. They have pretty nominal book cost, and they're ones where we've assessed them as being likely to happen. The prospect of either getting grid connection or ones already secured and getting planning are high. Therefore, we've been willing to contract with developers for them. And then in addition to that, we've got a further 4 schemes where we're in detailed negotiations. And these are schemes where we are still assessing the likelihood of them being delivered. If we get comfortable with them, then we contract them and then they feed through. So all those will slowly feed through. And these will be in addition to the ones that Jones Lang valued. So potentially you're looking at a significant uplift on that 29 million pounds. To give you a bit of an idea as to how the schemes are progressing, over the last year, we've had rental income from renewables has increased by 126%, which reflects the fact that we've had a lot of schemes that have gone into the construction stage and then subsequently become operational where our rent effectively peaks and is maximised. Then finally, on the sort of new project pipeline, this reflects the longer term strategy of really developing a capital light development pipeline where we secure land under conditional contracts, development agreements, promotion agreements, and options, as opposed to speculatively buying land. This ties up less cash at the outset, but allows us then promote the sites through the planning process for both residential and commercial uses. So in the first half of the year, we secured 6 further sites, which have the potential to deliver another 1,100 residential plots across 159 acres, and has an approximate gross development value of £57 million. The GDV is essentially the value of the land with planning if it was then sold in the open market. That's on top of, we've got around about 5,000 residential plots across 869 acres, which is already allocated. That has gross development value of around about £145 million. Some of those are held in joint ventures, so our share of that number is 70%, and 30% of those plots are owned freehold buyers. And then in the planning promotion side, we've currently got just over 4,000 residential plots we're promoting. These are held under these promotion agreements. They have an additional GDV of £185 million. And again, they're being promoted through the plan process over the next sort of 5 to 10 years. And then finally, a further 8 sites, which are now subject to agreed head of terms, and we're moving through legals with them, and they have the potential to deliver another 1,300 residential plots. On the commercial side, we have 5.3 million square feet of commercial allocated space, covering around about 500 acres on a range of different sites. That's got a GDV of about 800 million, which is the end built value of the space we could deliver on there. And all that lot together really gives a current visible development pipeline of about £1.175 billion, which gives you a feel for sort of the likely scale of the pipeline going forward. I'll pass it back to Gordon.
Thank you, David. So Germany. So for those who don't understand and know about our business, our German business, the top co is HRMS, split into 2 parts. Shareholders effectively own 86% of the business. Trading business is back-to-back trading, Germany, Northern Europe, supplying solid fuels, refractory minerals, pig iron, ferroalloys. Always back-to-back, and I'll talk about it in more detail. And then alongside that sits DK Recycling. The trading business supplies a lot of their raw materials. And what does DK do? It is the largest recycler of ferrous waste in Europe and possibly the world. And again, I will give you some detail if we just go over the page. So splitting the businesses into 2, this is quite a reassuring slide for me, because what we said to everyone is the trading team is back-to-back. And we all know that the economy in Germany is under real pressure. So therefore, they're at the lowest point. So if you look at the white box we talk about, we always expect their profits to sort of bump along at the bottom in a bad time. I would be worried if Germany was in recession and this was a high profit number, because it would mean you're taking a lot of risk. Stephen refers to the fact that the volumes are similar. So we're dealing with the same customers, but margins are under pressure. Therefore, we're getting a lower return. This trading team do not take risks. Their shareholders alongside us, or what risks they do take are very calculated, and they will not chase work to try and ramp up the profits. They are very much aligned. So the trading business you can see here is down. It's where I'd expect it to be at the bottom. And as the economy in Germany recovers, I would expect it to pick up. So to take you over the page, this is DK. DK is a fascinating opportunity. Now, one of the takeaways I would say is that if we at the end talk about some of the parts and you assume that we just get book for Germany, I think there's a lot of hidden value here that people haven't become alive to. We're going to do a capital markets day to give some detail, but I'll just give a quick helicopter over for people. At the moment, we take a lot of waste dust from all the steel plants around Europe. We're at full capacity, can't take any more. Stick it with coke and coal in a blast furnace, out comes pig iron, zinc and energy. The important point is we export energy, so we're not exposed to energy shocks. Next thing is zinc, it's a traded commodity. Big thing is pig iron. So there's 2 things on this slide I would draw your attention to. First of all is the steel dust. We import about 500,000 tons. Typically, it works at an average zinc content of 5%. But more and more of the steel plants are turning to electric arc, and that has a zinc content of about 8% that comes out of its dust. Reason for that is quite simple, because electric arc uses scrap's galvanized increases the zinc content. But the fact it's 8% allows us to drive prices up, and we're seeing significant movement in prices, so we're hoping to get much higher gate fees. You'll see that in what's happened in the first half, but we think it's a feature which will continue to grow as electric arc furnaces get turned on. So we think that's a positive driver on the inputs. Coal and coke typically track pig iron, they're very symbiotic. But then on the other side, what's happening in the pig iron? And there are three things that if you follow this market closely, you should be aware of. One, there is an embargo in Russian pig iron. That kicks in about June this year. Russia used to import over 1 million tons into Europe, and they were dumping it to get foreign exchange. The embargo now kicks in, which you would hope with that 1 million tons coming out of the markets, prices would move up. Second thing is CBAM. CBAM, if you Google, is the Carbon Border Adjustment Mechanism. And effectively what it means is if you come to Europe from 2035, and there's a graduated run out to this, but you will have to pay, potentially, if you look at the numbers, between 150 and 200 euros import tax if you bring it in from a country which doesn't do carbon reduction, which is obviously all of the carbon credit issues in the UK. So if you were bringing it from India, Ukraine, Russia, even if the embargoes had disappeared because of peace, you could be probably paying a couple of €100 a ton more to bring pig iron into Europe. So again, positive price pressure. The final thing, which I think is fascinating, is that a lot of our pig iron is priced off scrap. So if you look at it, we have a really high quality product, so therefore we get a premium to scrap, call it €50 a ton. Talking to one of the major steel companies, they are forecasting scrap prices to increase by about €100 a ton. Why is that? Really simple. All these electric arc furnaces are being built. They're not potentially going to be built. The cranes are there, they're being built. There's about, I think, something like 6 billion when you add it up of these electric arc furnaces to replace blast furnaces already, and that's only stage one. But what do they consume? Scrap. Europe has always been an exporter of scrap. It's now planning to be an importer of scrap. And you can imagine that switch in the logistics costs mean that the views are that scrap prices will increase. If they went up by 100, and I would be happy days if it did, 250,000 tons multiplied by 100, you'd see 25 million on the bottom line. This year, DK is at break even. I'm only giving you an overview of that at this stage. We really need to go into some detail with shareholders about this at Capital Markets Day. We're hoping to do it in the autumn, but I think this is an exciting opportunity. It's probably taken up 2 weeks, a month of my time out there, looking at the opportunities with the steel plants and end user customers. But I think we are in a really strong position. So just over the page, this is again where we demonstrate the turnaround. H1 is always bad because we have the summer maintenance. Every year we close the plant for 10 weeks at least to refurbish it, then we start up. So you always have a more difficult H1 than H2. H2 we're going flat out producing. We don't stop again until next summer. But look at key points I'd pick out. Coke price, as Stephen mentioned, we're beginning able to get coke cheaper. Fantastic trading team, best coke traders, I believe. I need to be careful when I say that. Of coke for steel industry, best traders there are. They have got good prices. They always follow. Pig iron and coke prices are symbiotic. Last time, remember, with Russia dumping material, there was a lag, but we're in the right place of the curve, so we've driven it up. But the other thing that might look a small thing here, but look at the gate fees. Despite every steel plant in Europe losing money, we were able to drive in the first half gate fees up by nearly $1 million. And you'll see a similar number in H2. So it shows you where the pricing power is, despite the fact that they all lost money. So we're confident that the business should break even. I think the discussion with shareholders is very much about what's the future look like at DK. So just over the page, what I hope between David, myself and Stephen is we've laid out the key points. One, we are delivering on our promises to shareholders. The team have dealt with the old legacy pension. That's behind us now. Progressive dividend is taking place, which is positive. Expectations in services are better than we put forward. We are conservative, so we have a strong outlook in services. And then I just ask you to sit down quietly and look at services. Services have a potentially very good outlook. Heathrow is a positive for us. I don't think I've mentioned that. So if you look at Rachel Reeves' announcement, that's not in the report because we didn't know what she was going to say. Blackwell's is one of the industry leaders in big earthworks. We are consultant on a lot of the major reservoir projects, helping them design those. So we hope that puts us in a good position. We were consultant on Heathrow third runway. I'd really like it to go ahead. It will be 5 years away, so don't get excited. But they talk about first spade in the ground in 5 years' time. I want it to be a Blackwell spade. To give you an idea of the earthwork spend, it's something like 700 million. So we did all the consultancy on what earthworks needed, and it's a great opportunity. But it is 5 years away. So, but all I'm saying is, genuinely, I think your services business is glass half full now in terms of opportunities. You apply a multiple to what you think is sustainable, that will give you a value. David's talked about land. Remember, we hold the land at historic cost. So he has 3 streams. Historic cost, just expect us to get book if you want to be negative. Then he's got renewables. As he's talking about, we hope before the next roadshow to do the first renewables transaction. And we hope that it will be at a premium to what Jones Lang LaSalle said. That's what we hope. And that sets the precedent of this flow out of cash. And Jones Lang will then start valuing the ones that they haven't valued before. So if you look at it, some people will turn around and say, well, that could be worth 50 million, but cost of 7, maybe a 40 million uplift. Again, you make your own decision, but there is a lot of hidden value in the renewables. There is hidden value in the land, but it's held at cost, so just expect to get booked. And then finally, this low capital model, really, if you look at it, David's got assembled a portfolio of nearly $1 billion, over $1 billion. And you would hope that would give you a recurring profit of about 3 million a year after overhead. Add in 4 million of overhead, so make 7 million gross, less than 4 million overhead 3. So that's there. Germany, just assume for the moment it's going to get booked. All the stock is in at cost, so yeah, that's easy to see that happening. And then DK is a really exciting thing, which just assume book for today. Let me update you more at the Capital Markets Day, and you'll see what's there. What I would finish by saying is, we do have a strong board. I'm an 8% shareholder. We're fortunate to have Harwood on the board with Nick Mills, who's nearly 30%. So shareholders are looked after. We have a strong chairman in Roger McDowell. The dividend is progressive and going in the right direction. My final point to you as retail investors is we value you equally, and all shareholders should be treated equally. So we look on the notice board sometimes and see questions come up. There's an easy way of getting your questions answered. Drop an email to Stephen and I, and we will respond to you and make sure that you are treated exactly the same as our big shareholders. Everybody should be treated fairly. So please don't feel this is the only opportunity to communicate. If you do want to ask us questions, we are very receptive, and our emails are there. And just send us an email, and Stephen or I will get back to you on any questions. But that sort of concludes the presentation. And I think now we hand over to yourselves for questions.
Perfect. Yeah. That's great. Yeah. Over to you, Stephen.
Yeah, so we've got quite a few questions in. This one is going to go to David because, as Gordon mentioned, he is a fellow Doncastonian, if that's the word. So we've got a question hailing originally from Doncaster. I'd appreciate a detailed update on progress at the Unity regeneration site alongside the M18.
Yeah, so thanks for that. So the Unity site is a big site, 650 acres, and it was opened up round about the end of the pandemic by a new link road that we partially funded. Comes off junction 5 of the M18, and effectively that opened up sites where we have consent for about 2.4 million square feet of commercial space. That's predominantly logistics, industrial employment space, together with consent for 3,000 new houses. So to date, since then, we've done a couple of significant transactions on the commercial side. So one of the early ones we did, we sold 80 acres of infrastructured site to TJ Morris, and that's Home Bargains, you and I, for a new regional logistics centre where they've just got their detailed consent on and are expecting to commence on site before the middle of this year. And then subsequent to that, we've done a turnkey project for 191,000 square foot logistics unit, which was completed towards the end of last year. And then more recently on the commercial side, as I mentioned previously, we've just secured planning for a couple of drive-through units to provide some facilities on the side. The residential expected to follow on from that. Over the next 24 months, you'll start seeing a bit more activity on that score as we start infrastructuring, preparing sites and bringing them forward to the market. But it is a long-term project. It's sizable delivery. You're talking probably next 10 to 15 years to see the whole thing built out.
Okay, thanks, David. Next question, I think, is probably for you, Gordon. Can you update as best as possible on Tungsten West progress and how that's going to turn into becoming a working operation for Hargreaves?
Yeah, so Tungsten West, I think I've said to everyone, because they're public, so you see their announcements, they're looking to go out for funding in 25. And look, if they get funding and go ahead, the plan is to mine it on their behalf, but it's open book and it's cost plus, and there's no credit risk to you. So it's all upside. If it goes wrong and they don't get the funding, then we can either restore the site or we can take the site back and someone else might be interested in buying it. So I think it's all heads we win, whichever way. So look, let's watch this space. Good thing is I think it will be resolved in 25, so you'll know exactly what's going to happen.
Thank you. Next question, probably for you, David. What's the nature of your investment into Blindwells?
Yeah, so Blindwells, we own the freehold of the site. It's a former mining site, so that is at a relatively low book cost. The initial investment was really infrastructure, so power, sewage, water, etc. And we invested something like £25 million to get the site opened up. And subsequent to that, it's been basically extending that infrastructure into the site, roads, sewage, together with ground remediation, which is essentially making it into a greenfield standard for development house builders. So really, as we go forward, then we just continue to invest in the site ahead of doing sales to house builders.
Okay, thank you. And then next question from Owen. Being that some land sales are delayed into next year, what news might shareholders expect between now and the next statutory results in July?
Can I pick that up?
Yeah.
I think that's a very good question, Owen. What I think is, if you look at it, you're hopefully before the next roadshow, you may have an announcement that the renewables has gone through, and that triggers an interesting point, because if you do the math, you suddenly go, well, hang on a minute, Gordon, if that happens, you're going to have over 30 million of cash in the bank. If that happens, that we will be in discussions with shareholders to talk about whether share buybacks or special dividends are possible, because we'll have over 30 million of cash in the bank, and I think shareholders would like us to look at what to do with it. So that will be a news flow. When Lower Thames gets announced, hopefully that'll be a news flow. Tungsten West, when having to them, that'll be a news flow. Then you get the full year results. And then on top of that, there's going to be this capital markets day, which again is very good, because we need to make sure that the retail investors somehow get to engage in that process.
Sure that can be arranged.
Yeah, so we mustn't forget that. So there's a lot of news flow coming, and we'll try and keep you as informed as much as we can.
Thank you. Another one from Mark. What do you think the implications of today's statement from the Chancellor are on the timing of the Lower Thames Crossing and Sizewell C projects?
I think it's all positive, Mark. Lower Thames is toll road, so I think it will go ahead, and if it does, great for us. Sizewell, we need to keep the lights on, so if it goes ahead, should be great for us. And the Heathrow is really exciting for us. Earthworks is about 700 million, and if these reservoirs she talks about goes ahead, we are already contracted to do the costings on some of those big reservoirs. So we've got more opportunity this afternoon than we did this morning. So it's all a positive.
True. Another one from Mark. Who takes over from David in his property director's role?
So a colleague of mine, Bruce Lindsay, who currently runs the Blindwells project, he's taken over the day-to-day running of land. I will stay on as a consultant just to deal particularly Unity, given it's a very involved project. But so you shouldn't really see any material change in approach or performance as a result of that, I would like to think.
Thank you. I can cover the next one.
Well done. You've got that. Good. I'm glad you're doing one.
Please, can you break down the loss on the Hargreaves land so we can understand the profit drivers? So yeah, so despite the fact revenue's been up in this year, we haven't got a large margin on that revenue that came in, partly because the purchase or the sale includes some deferred element, and we'll be taking the margin at the back end of that sale. Throughout the year, most of the cost is through the overhead of the business, to be honest, and that's what's driven the loss in the first half of the year. However, with the sale that we've achieved in January to Avant Homes, which was delayed actually 12 months previous, plus other sales we have in the pipeline, the business will return to profit in the second half. The current numbers out there on the Walbrook note and the two broker forecasts have a 2 million profit for land in the second half of the year, and that's driven by those sales at Blindwells, one of which we've already achieved. Second one, do you anticipate any material costs for converting the pension buy-in to a buyout? The short answer is no, I do not expect anything material. What will happen from now on is the insurance company who bought in the scheme are working through the data to check that all the data is accurate, no one's been married again or has any other dependencies that would increase or indeed decrease the liability they took on. Once the buyout is ready to be completed, and March 26 would represent 2 years from buy-in, and that's typically what they're looking at the moment. And don't forget, there was a big rush on doing pension scheme buy-ins, and so there's a heck of a lot of volume that the insurance companies need to work through. So I don't expect it to be before then. There may be a small true up or true down. It's difficult to say what that might be, but I think we're talking sub $1 million, if indeed it gets anywhere near those numbers. So no, I don't expect anything material. And then the next one from John, how is the employer NI increase in April 25 going to affect profits? It almost certainly won't, John. Most of our costs, as I think Gordon alluded to, on our services contracts are covered. So we either have escalation factors for inflation or staff cost inflation, etc. So we're able to pass on the vast majority of the cost onto our customers. Obviously, there's an element of back office staff and non-chargeable staff where there will be an increase. But I think the total impact of the NI increase is probably £100,000 to the group in total. So very, very modest in total. Nicole has got a very interesting question.
Yeah.
How optimistic on a scale of 1 to 10 are you about the future of Hargreaves Services?
So I suppose I should answer that, Nicole. It's a good question. Clearly, I'm not allowed to give forecasts. What I would say to you is I am more optimistic than I have been in the last 10 years. And I'm more optimistic this afternoon than I was this morning. So I think that gives you a flavour.
Yeah, it's difficult to put a number on it, but I think very optimistic is So Owen has another question. There have been noises from the government about increasing the number of water reservoirs. Can you offer any comment on this and what effect this might have for Hargreaves? I think we might have covered this.
I think we have covered it, Owen, but just to reconfirm, we are major consultant on some of these water reservoirs in terms of getting the design. Hopefully, if you do the design, you should pick up the contract. It's all good. I mean, it's a lot of earth to move, and that's what we do.
Great. Question from Brandon, which I can cover. Brokers have 6 million in for the joint venture, being HRMS in H2. Given the H1 result, is that number challenging? Would it be due to improvement in business or seasonality? I think Gordon covered the main reason for the H1, H2 disparity in Germany, and that is predominantly because of the shutdown period within within DK. The HRMS trading element has done okay first half and should do okay second half. But what we should see is DK coming back into profit in the second half and resulting in a break-even overall result. And that's what drives that 6 million in the second half, mainly because there's no shutdown in DK, so they can just trade profitably throughout the second half. And we've seen that in previous years, if you look back at the half year to full year split. Another one from Brandon. On renewables, would it be reasonable to use the kilowatt hours of the non-valued schemes and the 27 million of the valued schemes to calculate a value of those schemes? I.e., I think, is it as simple as £1 per megawatt?
Yeah, I'm afraid not. The reason simply being is that the wind farms have a higher yield per kilowatt to us compared to the access agreements, and the battery storage ones, which have generally much higher kilowatts hours measurements, tend to have a lower per kilowatt return from our point of view, because they're just very different animals from each other. So I'm afraid it's not as simple as that to sort of work it through. It doesn't work like that, I'm afraid.
All I would say and jump on that is, detailed stuff like that, have a chat with David or Stephen, and we'll go how you can build it. It would take too much time here. But some people have looked at it and said, right, as a rule of thumb, that lot in total, so the stuff that's coming through plus that was valued might be worth plus 50 million. Subtract 7, 8, and you're at 40 million of value if they all come through. That's rough hit on top of the book cost.
Yeah, I think it's material upside in there.
Yeah,
and
but we can work you through. There's assumptions to get to that you have to make your own calls.
That's fine. Next question: do you have a view at this stage on the preferred method of returns to shareholders as the cash is released from the various business units?
We don't. There's discussions at the moment whether it's buybacks or whether it's specials. We would value, again, please don't overlook retail shareholders. If you have a view, drop us a note on what you would prefer, and the board will take it into account. I think the key thing on that news flow is if the renewables go ahead before the end of this financial year, it's something that we have to seriously consider. And so the more input from shareholders as to what they would prefer would help us make the right decision for shareholders.
Great, thanks. And the last question is, I think, a straightforward one I can answer. So, was the 9.3 million for the 11-acre sale at Blindwells all received on completion in January 25? No, it wasn't. Half of it was received in Jan 25, and the other half will be received in March 25. So it'll all be in before the year end in total.
Well, that was the last of the question. Oh, sorry, Alex. That was the last of the questions. I'd just like to close by saying to you, look, thank you for taking the time to listen to the Hargreaves story. Hopefully it's clear that, based on a £6 share price, we're going to be paying 6% to watch. You have to decide whether you trust this management team to execute effectively. I think you've got strong corporate governance with Nick Christopher from Harwood and Roger McDowell to make sure that we don't do anything silly. But, do your sum of the parts, decide whether you think the team are capable of executing that effectively, and then hopefully you'll have a positive 5 years from Hargreaves. That's the message we're trying to make clear. But final point, please do not feel that you are a pain. You deserve to talk to us, and if you've got questions, please tell us. You don't have to put things on the notice board and discuss among yourselves. You can actually pick up an email to us and we'll give you the answers direct. So I encourage that, but it's up to you guys. So sorry, that is the final thing, Alex.
Fantastic. Gordon, Stephen, David, thank you for addressing all those questions and for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Hargreaves Services PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.